Ladies and gentlemen, good day and welcome to Q4 FY24 earnings conference call of Shoppestop Ltd. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Samat. Thank you, and over to you, ma'am.
Thank you, Ria. Good morning, and thank you all for joining us on the Shoppestop Q4 FY24 earnings conference call. Today, we have with us the senior management represented by Mr. Kavindra Mishra, Customer Care Associate, Executive Director and CEO, Mr. Karunakaran Mohanasundaram, Customer Care Associate, Chief Financial Officer. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that the discussion in today's earnings call may include certain forward-looking statements and must be viewed, therefore, in conjunction with the risk that the company faces. Please restrict your questions to the quarter performance and to strategy questions only. Housekeeping questions can be dealt with separately with the IR team. I would now request Mr. Kavindra Mishra for the opening remarks. Thank you, and over to you, sir.
Thank you, Mamta. Good morning, friends. Thanks for joining us today to discuss Shoppestop financial results for our fourth quarter. I have with me my colleague Karuna, who is our CFO, Jaiprakash, who is our FP&A lead, and Rohit from IR. I will start with an overall market update, then cover company's performance including KPIs, and in the end I will speak about the strategic pillars and way forward. As you are aware, the quarter started with an indifferent note with end of season sale advanced in December last. This impacted our Q4 Jan and February performance. The wedding season, which led to larger conversions last year, was missing this year. I had briefly covered in the last quarter on the delayed impact of winter, which started sometime in January, which was delayed by more than 2 months. This overall impacted the performance. However, we saw a smart recovery in the month of March. I will cover the details in the next few minutes. Let me start with the Q4 performance. We delivered sales of 1,232 crores with a 5% growth. To give you the right context, our sales were largely flat in January, grew by 6% in February and 13.5% in March. We grew by 9% like-for-like in the month of March. As January is a large USS month impacted by advancement of USS, it dragged the overall growth in Q4. Akin to the previous quarters, our performance was driven largely by beauty, Intune and brands, non-apparels in particular. The apparels also had a low single-digit growth during the quarter. During the quarter, our margins were largely flat versus FY23. The brand had higher offers due to slowness, and private brand is not an exception. The slowness and higher offer resulted in inventory provisioning of rupees 9 crores during the quarter. Save this, our margins would have been higher. Last quarter, I spoke about our cost base, which was built for a higher scale. As the slowness continued, we were reassessing our cost base. I am happy to inform you our like-to-like costs were almost flat. The increase in cost is due to 3 reasons. One, due to new stores opened in the last 1 year. Secondly, new business such as ssbeauty.com and Intune. And thirdly, investments in technology. I am fairly confident that our new stores and new business will start giving much higher returns starting this fiscal and will augment higher growth for the next few years. Overall, the costs increased by 10% due to the factors I have mentioned above. While our reported EBITDA was lower than last year, if we remove the one-offs and the investments in new business, our EBITDA would have been higher than FY23 by 6%. Of course, we need to invest in long-term growth. We prefer to trade higher growth than profits in the short term. On some of the other KPIs, such as our strategy of premiumization continues to yield better results. During the quarter, our Premium Plus portfolio grew by 25% and we added more than 10 new brands such as Dockers, Beverly Hills Polo Club, Gant, Salt, Sound, and Sistri and Folk Songs. This resulted in the ATV growing by 8% versus last year. This has also resulted in increasing our ASP by 4%. The thing which we are very proud is that our items per transaction grew by a healthy 4%. During the quarter, we opened 7 departmental stores, 3 beauty stores, 12 Intune stores. We promised to open 56 stores in this fiscal. I'm extremely happy to say that we opened 55 stores and we would have had 1 or 2 more except for the regulatory approvals which were deferred due to multiple reasons. Overall, we invested rupees 84 crores during the quarter and 246 crores for the full year. Our strategy of opening stores in Tier 2 cities such as Kota, Agartala, Kanpur and Shillong are performing as per expectations and is helping us well. For the full year, we have reported a revenue of 5,228 crores, an increase of 3% over last year. Our beauty reported sales of rupees 887 crores, which is an increase of 8%, and private brands reported sales of 689 crores, declined by 5% over FY23. For the full year, we have reported an EBITDA of 226 crores, PBT of 87 crores, and PAT of 57 crores. Our KPIs have improved in the last 12 quarters. I will briefly speak about our 3C framework. First one being customer centricity. With the help of advanced data analytics and technology, we have the consumer shopping habit, purchase history to create personalized offers, recommendations and communications. This not only enhances the shopping experience but also deepens the emotional connection between the customer and the brand. And this is something we are consistently working on. Second is consistency in growth. Our long-term goals are consistent, which is to grow the core. The 2 ways to grow the core are penetration and premiumization. Driving penetration involves widening the base of users, which we are doing by opening number of stores, entering newer cities, strengthening the private label and increasing the loyalty base. I've already covered the premiumization journey before and would be happy to answer any queries on that later on. The third one being capital allocation. Overall, the capital allocation would be higher to departmental stores, Intune and beauty. During this year, we are planning to spend rupees 275 crores in opening circa 100 stores and renovating some of our top stores. From operations, I will now move to the performance of our strategic pillars. First one being First Citizen. During the quarter, our sales from loyal members were at 78% with 65% repeat purchases. Our First Citizen contribution in beauty has increased from 61 to 71%. Our members are just a shy away from the 10 million mark. Our premium Black and Platinum members contributed 12% of sales and grew by 14%. We had memorable customer events including such as Spring Summer Launch, Gifts of Love campaign, unique activities for our First Citizen customers and actively engaging them through our Black and Platinum card. We have further divided our First Citizen customer as personas. We are now targeting personas based on their behavior, working very closely with the brands to improve the customer journey. Now let me talk about private brands and Intune. We continue to have challenges in private brands and is declined by circa 5% versus last year. For this year, we have a new strategy on private brands which is differentiated product offerings of each brand to prevent cannibalization within and across brands. Clear and defined brand positioning by offering assortments that resonates with the target customer and connects to inspirational brands. Unique product and designs at affordable prices that is exclusively available at Shoppestop. Our operational focus is to improve margins and reduce and optimize the inventory. Our trading margins for the new season are on the rise, but the financial margins are impacted by write-off. We have been successful in reducing the inventory to rupees 134 crores, a reduction of more than 50 plus crores versus last year. We have introduced 500 new options in the month of April, and as I have mentioned before as well, we see the likely turnaround of private brands apparel business sometime in Q2. From private brands, I will move to Intune, our success story in the last 8 months. We have opened 12 stores during the quarter. Probably we would have opened a few more, but we are waiting for the regulatory approvals. Some of the key factors for our initial success in Intune are, first, our mature stores, that is stores which have been opened before December 23 had the highest sales in March. Our customer conversion is at 33% and as I speak, it has further increased in April. Our margin delivery is intact for a new business. Overall, EBITDA margin at the store level continues to be positive in our first year of operations. The store expansion is on track. We are able to identify good locations at reasonable cost and the pipeline is quite robust. The capex per square feet is sustained at rupees 1550 per square feet. This will help us to improve the overall return on capital employed. Our continued interaction with customers helped us to improve the retail KPIs such as sales per square feet, items per ticket, and ATV, which is average ticket value. I'm excited and at the same time very proud to say that this new business in Intune has been on the right path and will invest more in this year and years to come. Now let me talk about beauty. Similar to previous quarters, we are over-indexing on beauty growth. The recipe for beauty success, as I said before, is the investments made ahead of time besides the vision to grow premium beauty business in India. In beauty, we recorded sales of rupees 218 crores with a growth of 8%. Our beauty contribution sustained at 18%. We did more than 878,000 makeovers during the quarter. As I said earlier, we'd opened 3 stores. During the quarter, we opened the largest beauty store in India in the most prestigious Bridge to Luxury Quest Mall at Calcutta. The total area of the store is 9,000 square feet with many celebrities attending the event. We have some of the best global brands such as Dior, Estee Lauder, Armani, Prada, NARS, MAC as a part of the store. The overall operational and financial parameters since opening the store are as per expectations. During the quarter, we also launched 7 beauty brands, including 31 new SKUs in our private brand Arcelia. Our beauty distribution brand continues to be on track. Let me speak about Homestock. Our Homestock business, though small, has been a pillar of success for some time now. I will briefly speak about this. Home grew by 30% with like-for-like growth of 20%. Shop-in-shop stores, the SIS stores registered a healthy like-to-like growth of 63%. Personal shoppers' contribution increased to 25% of total home sales. The home journey has been quite exciting and we are looking at a high level of growth here going forward. Now let me talk about CAPEX, working capital and cash flow. For FY25, we are planning to spend rupees 250 to 275 crores and we are reasonably confident we will source this from our internal accruals. Our working capital has increased during Q4, which is in line with the business trend of retail. It is pertinent to know that our private brand apparel inventory has reduced by 56 crores versus FY23. Now let's talk about the outlook. As always, I conclude my speech with emphasis on strategic pillars to drive our sales. Even in these tough times, we have consistently demonstrated agility with razor-sharp focus in enhancing consumer experience and enhancing our operational matrix. With our partners, we have run some numerous impactful campaigns across occasions and brands and categories. We remain committed to delivering exceptional product and experiences to our customers. Furthermore, we shall continue to maintain our position in the market through targeted expansions, focus on appropriate capital allocation and building premiumization. The broad outlook for FY25 will be, first, to have exclusive brands across categories to drive that, which will help us to drive premiumization, exclusivity for our loyal consumers and improve the customer experience. Second, we will experiment newer categories. For example, we are now opening cafes in our stores and we are very excited by the entire fact. We believe that apparels are poised for recovery in FY25 and the women's ethnic wear line has shown some very, very strong performances across the board and we are very confident about that. For our business, the outliers will be beauty and Intune besides beauty distribution. They are poised to become crucial growth drivers for our company going forward. I am confident that the consumption environment will improve post-elections and I am confident that our investments in new stores, premiumization and enhancing consumer experience will yield disproportionate growth. I conclude by thanking you once again for attending this call and we are now open to questions and answers. I have with me Biju, who is CEO of our beauty business, and Devang, who is business head for Intune business. They are here with me to answer any queries about their respective businesses. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avnish Roy from Nuvama. Please go ahead.
Yeah, thanks. My first question is on the private brand. So, last many years, there have been a lot of iterations here. So, you have worked on pricing, assortment, overall look and feel of the stores and everything, sourcing also. But it still remains work in progress, still at 13-14% of the sales. So wanted to understand out of sourcing, pricing, assortment, etc., what was the thing which did not work? And this time, what will change? Because you have tried earlier, there's a lot of competition. So is there a white space available from an industry perspective to do something different here?
Yes, great question, Amish. So if I look at the private brand business, if you break that business into 4 parts, we have women's Indian, we have kids, western women's and menswear. There are these 4 basic broad categories which we have. If I look at the business, the women's Indian and kids is doing outstandingly well for us. They continue to grow. In fact, women's Indian business, the GMROCs and the throughputs are far higher than the brands business as well. So that's something which we'll keep on over-indexing and building on. When I looked at the business from outside of Shoppers and now inside, I feel that there is a lot of work which we need to do in 2 categories. One is menswear, because believe that the positioning of few of our brands was a little confused. So we have cleaned up that positioning, and you will see the new avatar of menswear brands and the way they are positioned and the product lines in a very, very sharp and focused way from autumn winter. And that is where my confidence comes in terms of driving profitability and GMROC there. The same happens with women's western, which the category itself was under a lot of pressure, and we have worked on it to change the product and the positioning. I think what is very clear in our mind is that we are looking at private brands business as a business where we are not taking them only as in terms of label to increase the proportion of business. We want them to be as strong as any other brand in terms of the profitability of the overall business. So we focus on the GMROC and profitability instead of only the mix, which is something which people look at. I think the whole idea of positioning the products, making the brand sharper, that is something which we are driving very, very strongly. We also see that there are certain areas where we feel that the private brands can become stronger. For example, there's a clear case for us. We have a brand called Incense, which is women's sleepwear, does really well. So I think those are the categories for which we don't have equivalent brands in menswear. So I think that's one category we are looking at building on. Also, we have seen that men's ethnic wear is something which, and Indianization is something as a trend is going on very, very strongly. So for us, the private brand can really be focused, the one Bandhya, which is our private brand in menswear, can really focus on that piece. So we are picking and choosing areas where we want to focus the private brands and drive the business.
Sure, thanks. My second and last question will be on Intune. So currently around 22 stores, and your earlier expectation was around 24 stores by FY24. So you are fairly close to that. Now a very sharp scale up to 60 stores. So my specific questions are on the franchisee mode. Any further thoughts to share? And if you compare to the other much larger player in this segment, Zudio, they have opened 193 stores. So on a very small base, you want to open 1/3 of what Zudio is doing in the second year. Isn't that too high? And what is giving the confidence, and what has been the initial learning in this format?
So I will ask Devang to answer on the part, and on the franchisee, let me answer. But I will first ask Devang to answer the business part of it.
Hi, Avnish. Thanks for the question. If I understood you correctly, the question is more on the lines of why the aggression of 60 stores on a base of 22 stores.
Yes.
Right?
Yes.
And I think the answer lies in the continued success that we are seeing in the first 22 stores. Now we have stores which have seen as much as 3 quarters, and they are holding up. They are existing in their own right amidst stiff competition. That's reason number 1. Reason number 2 is our differentiation compared to all the other players in the market is now becoming more and more evident, as we've covered in the deck as well. The pillars on which Intune stands continue to deliver. That gives us the confidence that as we scale up, we will create our own identity, right? And the third thing is, I think, we've taken the last 2 quarters, we've told this in the last investor call also, we've taken the last 2 quarters to build the resources required to grow this aggressively. So this aggression is not coming without adequate amount of planning. So all the efficiencies that you need, all the risk mitigation that you would need to ensure that this aggression doesn't come at the cost of profitability or sustainability, all the effort has already happened. It's only with the confidence of these things in the past that we've taken a target of quadrupling our network in the next year. Right? I hope the question on aggression stands answered. Kavi can take up the franchising part.
So on the franchising part, Mish, I think again this is something we have discussed before as well. We want at least the first 1 full year the cycle to be completed, because getting into the franchisee mode is something which we can easily do. We have inquiries from a lot of partners, but we just wanted to be very sure about the whole cycle, and once we go to the partners, then we can expand. So I think it's a matter of time. We are just ensuring that whatever learnings are there, at least for 1.5 years, we are able to incorporate that, become very stable as a business model, and then when we go to the partners, we can actually expand it very, very quickly. So we have the lineup, the pipeline ready with us. We are just waiting to ensure that we do that basic due diligence of crossing those quarters, crossing the year, seeing 2 seasons of sales, everything gets streamlined, and then we move ahead. Because opening a franchisee store is like a promise. You can't go wrong in that, and you can move very fast once you crack it.
One follow-up question. Your commentary on Intune seems quite positive and sharp scale up versus 22 stores, adding 60 stores. My question was, a lot of things which are going right for Intune might also be applicable for your private brands business. So is there some KTF from there, or because if a lot of the decisions in terms of sourcing, I understand pricing is different, but in terms of the overall strategy, lot of commonality will be there. So are you already getting some bit of that being built into the private brands?
So we see the private brands operate in an atmosphere where they are compared with national brands, right? So I guess there are 2 parts of it. The product part is very different, Amish. The white spaces which you see in a departmental store are very different from the white spaces which you see in an Intune kind of business. Having said that, I think the agility of the team, the desire to drive costs rationally, I think that's something which there is a lot of cross-functional learning and understanding which is there. I think the agility is one of the things which we are looking at very strongly. So we are working on these things, but both the businesses are very different in terms of the approach, especially given the product, on what products to make. It's a different ball game because we are working on against a different competitive set. Having said that, moving into a tighter, I think one of the focuses on running the inventory very tightly, moving into a 60-day cycle instead of a 180-day cycle like a traditional brand. I think those learnings are well captured, and that's how we are driving this.
So thanks. That's all from me. Thank you.
Thank you.
Thank you. Next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So just continuing on the private label part, do you think consumers are downgrading to value fashion now? Because pretty much in whichever mall today Shoppestop is on High Street, we have a Zudio or a Intune or a Style Union next to that Shoppestop. And consumer today is not willing to pay for the brand and hence buying a private label in a Shoppestop. For the same reason, we could be walking out of a Shoppestop buying an Intune, the same product, and pretty much the markups are much lower out there. Do you analyze the consumer data? Why are they entering Intune? Because Devang would be wanting Shoppestop consumer in his store as well, and not only upgrading from unorganized market to Intune.
Yeah, I think a great question, Ankit. This will take a lot of time to answer, but let me try and address your concerns. So I think there are 2-3 things. One I said, see, if you look at our business, if there are 100 people who are entering within Shoppers, around 21% is the conversion. There is a 69, 70 or 79% which doesn't get converted, right? So there is a scope for private brands to build that customer and drive that conversion basis the right product, right pricing, differentiation. Obviously, the customers are willing to pay the price if the product is differentiated. So if the product is differentiated and the pricing is right, and I think that's something which we are trying to build upon in the private brand business. So you will see that while the product has gone up in the fall winter line which will present, the pricing has become sharper because we have been able to negotiate the cost better. So we'll be able to provide great value for the product at the right price, right? What we are also seeing is that the Shoppestop customer is a more premium customer in terms of the choices which he or he makes. We have seen that across brands, that behavior across brands, across categories. And even within the set of private brands, what we have seen is that the brands which are able to capture differentiated product, so aspirational product at great pricing, I think they have really done well. For example, Bandeya I spoke about, which is the menswear ethnic brand for us, or for example, Kashish or Stop, they've done really well. So the idea is that we work on, so we already have successes of private brands within our portfolio. The desire is to ensure that those learnings get captured across categories. And that is what the drive we have in the coming season. So I'm very confident that what we are doing in terms of the product, in terms of the pricing we are doing. Also, the desire is not to only leave them as a label or as a product, also to work on marketing, do campaigns throughout the year, connect with the customer, use associations to ensure that private brands are seen across the board. Because I think at the end of the day, you start the journey with the product, then you do the communication and build the brand. I think in the past, at times we have been guilty of doing one or the other. This is a more concerted effort across the board.
Tony, if I have to just twist this question, we have, multi-million consumer data with us. At the same time, Intune would also be capturing the same consumer mobile number data. How many of the customers are overlapping between a Shoppestop and a Intune today?
So we have started doing that, but I think it's negligible as we speak.
Understood. A second question is for Karuna. Karuna, in the slide of normalized Q4 EBITDA, there is a lot of one-offs out there, be it on Intune, 4 crores, SS Beauty, along with inventory write-offs. Can we have the same number for full year and for Q4 last year?
Full year, I can probably send it across to you, or we will publish it in the addendum. Last year, I did not think of we had any one-time write-off or an income impact. Probably last year, we would have received some income because something would have been there, but very unlikely. Just see all the three reasons. One, Intune was not there last year. SS Beauty In was not there last year. Inventory write-off of private brand was not there last year. Okay, these three items were not there last year at all, and this gives you the largest impact. And we did not open any large store last year, like the amount what we spent in Quest Mall is something different, unique, and we want to do that. So none of these items were present last year, but having said this, Ankit, we will go back, we will see anything is there. See, if it was there, we would have informed you in the analyst speech. The very fact that we have not said anything, it wasn't there. But again, I repeat, we will go back and we will see if there anything is there.
Sure. Just on the inventory write-offs, given that 50 crores of inventories reduction we have seen this year, is it fair to assume your margin expansion in FY25 will be partly led by lower inventory write-off this year, given that inventory in private label is very, very fresh?
You're absolutely spot on, Ankit. When we did the budgeting exercise for FY25, we have factored the increase in margin in private brand. But please remember, at the overall company level, Intune mix will go up. So to that extent, there will be some offset, but overall, we expect the gross margin to increase in FY25.
And my last question is for Biju. Biju, we have seen 12, EBOs of beauty closed this year. Along with that, we are opening stores and investing in the bigger stores. And the capex for the beauty stores is virtually 4x a normal, Shoppestop or the Intune capex per square feet. From a ROC perspective for the SS Beauty or for, a Quest Mall type of a store, when do you see a payback happening? And do you see this kind of capital employed in beauty business, be it even the distribution business of beauty, justified for the current EBITDA the beauty business is, throwing?
So hi, the first part of your question